The subprime mortgage crisis was a financial disaster that unfolded in the late 2000s, leading to the global financial crisis of 2008. It was caused by the collapse of the U.S. housing market, driven by risky lending practices, excessive speculation, and a lack of regulation. Here's what happened. Leading up to the crisis, banks and mortgage lenders began offering home loans to borrowers with poor credit histories, known as subprime borrowers. These loans had higher interest rates to compensate for the risk, but they often came with features like low initial payments or adjustable rates that increased over time. Many borrowers could not afford the loans once the rates reset, leading to widespread defaults. The crisis was amplified by mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. Banks bundled these subprime loans into financial products and sold them to investors, promising high returns. Ratings agencies often gave these products high credit ratings, even though the underlying loans were risky. Investors, including pension funds and international banks, bought these securities, spreading the risk across the global financial system. As housing prices soared, fueled by demand and speculation, many borrowers and investors assumed prices would keep rising. However, around 2006, the housing bubble burst. Home prices began to fall, and borrowers with adjustable-rate mortgages faced higher payments they couldn't afford. Millions of homeowners defaulted on their loans, and foreclosures surged. The defaults caused the value of mortgage-backed securities to plummet. Banks and financial institutions holding these assets suffered massive losses. Major players like Lehman Brothers collapsed, and others, like Bear Stearns and AIG, required government bailouts to avoid a complete financial meltdown. The crisis led to a credit freeze, where banks stopped lending to each other and businesses, fearing further losses. This triggered a severe recession, with millions of jobs lost, businesses failing, and trillions of dollars wiped out from global markets. In response, governments and central banks implemented emergency measures. In the U.S., programs like the Troubled Asset Relief Program, TARP, provided bailouts to stabilize banks, while the Federal Reserve slashed interest rates and introduced quantitative easing to stimulate the economy. The crisis revealed flaws in financial regulation and led to reforms like the Dodd-Frank Act, designed to prevent similar events. This legislation introduced stricter lending standards, increased oversight of financial institutions, and aimed to improve transparency in complex financial products. In summary, the subprime mortgage crisis was caused by risky lending practices, speculative investments, and a housing bubble collapse. It triggered a global financial crisis, leading to massive economic disruption and regulatory changes. The crisis serves as a reminder of the dangers of excessive risk-taking and the importance of financial oversight.